everybody, and welcome to the Fred Report conference call for April 7th, 2011. Certainly some interesting times here, so we'll get right into the call. We're in Washington, D.C., by the way. We'll respond to emails as we can, but I am teaching this afternoon, so we'll be away from a computer for much of the day. Okay, first of all, with the stock market, obviously we've had a little bit more of a negative slant to our writings lately. We are still expecting the spiders to challenge 135, currently at 133.77. They've got some more upside. We point out that the hardest thing to do is to pinpoint or forecast a top in an uptrending or bull market, which is what we're trying to do. But we do want people to take note. As stuff hits sell points, as stuff gets stopped out, I would keep the cash and maybe even raise a little bit of cash if you've got some issues that are not trading as well. We can get a sharp pullback in the market into May, which has been our forecast. I think that can go to 122 to 123 on the spiders. There's a gap down there that would exceed the 126 level. And we note, guys, we had 15.7% bears, and that has led to a sharp drop within 2 months almost all the time, especially in recent history of the market. So, you don't start big new up moves at 15.7% bears. Sometimes the market will consolidate and the percent bears will go up. Sometimes the market will fall. But we've also got a monthly set of indicators, our longer long-term indicators, that are also suggesting there's some issues and a sharp pullback is possible. We're very happy, by the way, with our sector allocation. The XLP has hit all-time highs. XLY is trading better than a lot of the other sectors. It's within a few percentage points of its all-time highs. And we like materials. They have picked up very sharply. XLB actually hit new highs for the move yesterday for the bull market from 2009, although it's below all-time highs. So basically, we're happy with our sector allocation. We continue to be concerned about technology. Tech is now way below the highs set earlier in the year. 8 out of 10 Wall Street strategists still really like tech. Our plan is to look to upgrade technology on one of two things or possibly both. First of all, if we do get a market correction, we will likely upgrade tech. Second of all, if we see the sector being downgraded by strategists, we will look to upgrade tech. We also are looking at some of the other type stocks in tech, stocks like Microsoft, Cisco, and such. We'll talk about those in the stock section of the call. But the market may be moving away from some of the big high flyers like Apple, although Apple is down and no longer a high flyer, and recycling into littler stocks that are down, and that might be something we can do as investors. So we're going to keep our eye on that. Looking at the bond market, the TLT, it has been much weaker than we expected. We kind of thought we were going to hold the 92 area, and it looked like we were pretty much doing that until yesterday's bad action, which has taken us down to test the 90 area. We still have accumulation models that suggest a bond rally could occur. We are maintaining light bond positions in our advice. We think, though, that the bond rally is only going to occur if the market rally occurs, and that, again, as we said, is difficult to project. We, again, recommend advisors to do laddered portfolios and such in bonds if you're investing in bonds. In terms of the commodities, gold and silver have been a little stronger than expected. They are having a little bit of trouble, especially gold up in this area. We maintain our 152 price target in 14 months. Any move back below 141 on gold would likely suggest a test back to the 136 area. This could definitely occur, and if it does, we would overweight gold. We still look for strong moves in the commodities in the second half of the year, even if they stay up here. In terms of the USO, by the way, 44 is a major point. We're at 43.51. It has made new recent highs. We do like oil, especially longer term. If there is a sharp pullback in the USO to 38 to, well, say 39 to 40, we would probably become a lot more aggressive there. And we're looking to do that also after May for summer seasonality. seasonal tendencies are such that sometimes you just flatten out a little bit and then accelerate when the seasonal tendencies come into play. That's certainly possible here, and we are looking for a second half that's quite strong. In terms of the dollar, we have been looking at the possibility that the dollar is making a bottom. We point out the yen has come down as forecast, but we don't think that that has anything to do with much of anything other than news. I mean, the accumulation model said it was going to come down. The accumulation model did not say we were going to have an earthquake that was going to change Japanese fiscal policy, though. So while it is down, we think that's largely a news-driven market. Looking at the FXE, it's holding this 142 area, but if it were to move back down below 140, it would suggest a sharp dollar rally. Sentiment on the dollar is extremely negative. And we do see the possibility of a dollar rally, especially if the U.S. dollar index makes it above 77. Right now, the U.S. dollar index is around 75.50. It's still holding support. Not a lot is going on there, and stochastics are positive. But the trend is down, and obviously trying to buy something in the downtrend is difficult. We're not really doing any buying in the dollar until it gets above 77. We're just pointing out that there could be a big change there. In terms of the stocks, we've been asked about some interesting stocks. First of all,